even though the rain is not going to keep us away from talking about alternatives and how we're going to master them. So let's start with Matt from KKR and talk about alternatives. In my practice, I spend a lot of time discussing with various asset managers about push into alternatives, what it means to democratize access to this asset class. But on the flip side, I also hear from a lot of RIAs in terms of, how do I access this asset class? Is it appropriate for my clients? What's the liquidity profile? Matt, KKR is a firm that has spent a lot of powder to push this asset class forward. A lot of education is being done. How do you think about alternatives? How do you think about different wrappers for alternatives, but also RIAs, and what are they asking you when they're talking to you about this asset class?
Yeah, thanks, Vadim. So we think it's a natural extension of our business. For the last almost 50 years, KKR has been managing assets for pensions and institutions. But if you think about the end beneficiaries of those investments, it's individuals. And with the rise of technology, with the rise of the adoption of alternatives from major asset class players like KKR, it's brought different access points for wealth management clients. And now they can benefit from the same features that institutional clients have had for decades. We all can talk about the different features of alternatives, whether it's using them for additional income, capitalizing on the illiquidity premium, additional return, or diversifiers and low correlation to your traditional investments. But now we're at a stage where it's the 2.0 phase of alternative investing. It really started back in the early 90s with the interval funds being launched. First interval fund was launched back in 1993, but really was adopted in, call it 2016, in a yield-starved environment where a lot of investors were trying to capture more income when rates were at zero. Fast forward to today, and you've had the launch of the NTR 2.0s with Blackstone having tremendous success and it becoming really the biggest contributor to their bottom line. And so you see a lot of alternative asset managers like KKR figuring out how can we package access to alternatives in something that's accessible for individual investors. And so today we strive across our 4 asset classes: private equity, infrastructure, credit, and real estate. We have different options depending on the preference for individual investors. An evergreen semi-liquid option, we will build feeder funds to lower minimum investments for QP clients, or for some RAs that want to come direct, we have the ability to accept them direct. But I think it's been an interesting evolution, and now you're seeing that next phase where certain structures are correct for credit, BDCs, you've got REITs for real estate. There's 40 Act vehicles that have trade-offs to what we're doing, say, in infrastructure and private equity, which is we built operating company vehicles so that we could own and control and operate those assets within the vehicle. So I'll stop there, but I think it's very important, and I think it's going to continue to rise.
Yeah, absolutely. And I think the innovation that we're seeing in the industry with the operating vehicles that KKR is bringing to the market is really unique, and I think it gives a lot of options to investors, including RIAs. Lindsay, when you think about where Crestview fits within this, the competitive landscape, if you will, right? You have your KKR, maybe a better known name than others. How do you think about the RIA channel and also accessing the individual investor as opposed to institutional investor? And what are some of the things that you have to do to educate that investor in terms of Crestview and the strategy that it brings to the market?
Yeah, thanks, Vadim. So there's a lot of flavors of alternatives. Where we focus is in the private equity landscape, and in particular, we are a manager that's doing value-oriented investing in the middle market. And it's a top priority for us, for our organization, to access the RIA channel, continue to build out our investor base of high net worth individual investors. We've been fortunate to do that just because of some relationships we have ongoing, but it's harder for that channel to access smaller managers. But I think there are so many flavors, and it's really important that the end investor is thinking about building a diversified portfolio of alternatives, just like when you're putting together a traditional equity portfolio or a fixed income portfolio. And I'd say we even have conversations with the institutional investors about this. They're probably have more resources to think about it, but you would, as a correlating to a client's equity portfolio, you would never just do all large cap stocks. So the same in alternatives, and obviously KKR plays a big role, and they have a big presence. But you want to have diversification and not just do all the large cap managers. You want to have middle market. We'll talk a little bit about lower middle market. So from a capitalization perspective and the types of investments that your end manager is investing in, you want to diversify across size. We sit in the middle market space. We happen to think it's the best place to be because of the number of companies available to buy, what we can do to transform them, how we can generate great returns for our investors. And there's all sorts of great data that shows that middle market private equity and obviously private equity in general has achieved stellar returns over the long term. But then the other aspect of it, and I think this is certainly less known in alternatives, or less, I guess the thinking is less developed, is the growth versus value strategies. And there are very few opportunities to make value investments in private equity and alternatives. It just happens to be what we've been doing forever. But when we're talking to RIA clients and our end investors about value, buying businesses at attractive valuations and selling them at higher valuations, it's sort of back to basics. Value's obviously been out of favor for many years on the public markets and has had sort of a similar rap on the alternative side. But over the past 18 months, there's been, I think the change in the market has certainly caused alternative investors, private equity investors, both the institutional all the way down to high net worth, to think about where they need to be diversified and how having diversification can provide real benefits, especially when markets get more challenging. Having a value-oriented investor, a value-oriented manager that's focused on downside protection and doing creative restructuring transactions, all of that can be very beneficial. So I guess the key is to think about diversification and not just having one flavor of alternatives in portfolios for clients, and then how to think about what types of strategies that you want. And that's when I think some of the platforms come in handy, because there are now a growing number of ways for clients to access that. So maybe I'll pause there.
Yeah, I mean, I think it sounds like education plays an important role in terms of understanding the various flavors that alternatives come in, right? We may talk about private equity from a KKR standpoint, but that doesn't necessarily mean the same type of private equity access from a Crestview standpoint. Right. Exactly. Middle market, lower middle market, and private equity is just some of the flavors that are available in a private market access strategy, right? Brett, private credit, I think I've read more articles on private credit over the last 6 months than I've read on any other topic, or maybe it just tells you what I'm reading. But I do think private credit is an asset class. Cool, sexy stuff. Private credit is something that a lot of folks are talking about. A lot of managers are launching products, and a lot of RIAs are asking questions whether it's appropriate for them. Private credit, secondaries to an extent because of what's going on in the market currently with funds. How do you think about those asset classes? How do they fit into an RIA that's looking to diversify their clients' exposure? And also, how do you juxtapose that with a public equities exposure if it goes?
Yeah, it's a great question. I think first off, I've been doing alternatives in the lower middle market for just over 20 years. And when we started our first lower middle market private credit fund in 2004, it's really with an end outcome in mind. So when I was at Solomon's with Barney, at the time we were the largest financial institution in North America, and we were managing money for one of the largest wealth management firms in the US, which was Smith Barney, as well as for insurance, public, and other assets that were under the Citigroup umbrella. And we started the firm because ultimately it's the end outcome that investors are seeking. Less correlated assets, more defensive assets, higher yielding assets, and then for taxable investors, one of the big benefits of the lower middle market is the long-term capital gain attributes that come along with it. And I think one of the things that is surprising to some folks is thinking about how big the lower middle market is. It represents nearly 50% of all of the GDP in the United States. So if you ask yourself, what's the most established economy in the world? And well, there's challenges in the U.S. I think most of us would agree that the challenges in the U.S. are likely lower than a lot of the other challenges in the world. And so when you think about hunting for alpha, which is what Star Mountain Capital is as an alpha specialist, you can find it in your backyard here. The challenge is, well, how do you find it? So with our firm, for example, we have 80 full-time people located in 20 cities across America. It's engaging with business owners, and roughly the 2,000 investors that we have, many of them are high net worth individuals, family offices, and others that made their wealth owning and running businesses. And when we think about the aging demographics in America, of course, nobody here is aging, and we're all going to find some interesting pills that Peter Attia and everybody else is going to help us live to 150 or so. But putting that aside, the economy is aging, and you have more business owners looking to sell their businesses than ever in history. And so if you have a specialized business that can help finance those acquisitions, that's a very accretive use of proceeds. So when you look at the high interest rate environment that Matt referenced today, which is very different than the environment we lived in before, you have to ask yourself who's willing to pay these rates. And finding businesses that have a good use of proceeds is valuable. And then ultimately bringing those products and structures into, RIAs and other investors in different structures with and without leverage, different liquidity considerations is what, I think we all do across structures. The last thing, you've probably heard a little bit about secondaries, I'm guessing. It's also in addition to credit that Vadim likes to read. He didn't tell us if he reads it going to sleep or not at night. I guess that's the one question.
Depends on the day.
That's right. But within secondaries, aging demographic people are selling their portfolios as well, and other folks that are looking for early liquidity. So for investors that are wanting to get into seasoned assets, and other assets that have, again, a long-term capital gains benefit where you buy an asset at a discount, if it grows to par, that can create additional long-term capital gains with private credit, higher yielding income. So I guess it's pretty obvious why that's an end outcome that people are looking for. And that's, again, something we've been doing for about 20 years and is something that today is more popular than it's ever been, partially because of the aging demographics and because the asset class is so much larger than it was 10 years ago. I'll stop there.
I maybe add one point on that. I think what you described on the secondary market, it's really made the illiquid nature of alternatives so much more liquid. We've had examples of investors who have had life events change their liquidity requirements, change their need for, needing some liquidity from their investment with us. And, over a weekend or, 24, 48 hours, we've been able to facilitate a secondary transaction for them, which, was really helpful. And it was for both sides, for the buyer and the seller. So, I think that there's often sort of a concern about locking up capital for a long time. It's not necessarily the case that the technology in the secondary market has become so useful and so seamless. But then on the other hand, it's sort of good sometimes to have capital locked up.
We've had people to that point. We've had investors that have bought a secondary of our secondary fund. Right. If you have good assets, venture capital is a different ball of wax. Sometimes it's in favor, sometimes it's not. But if it's durable, value-based, private equity, private credit, real estate infrastructure, there's a very deep market today in the quote-unquote illiquid space that you generally can't liquidate on a spot day market. But there are large, robust markets that people can sell and brokers that help with it. And I know you work with a bunch of those as well. It's a great point.
Yeah, and I mean, there's a couple of good segues there. I do want to make sure if there's any questions that people get a chance to ask those. The one segue is about liquidity. The other segue is, I was fortunate enough to meet you and get access to you, but Matt, Opto Invest, not everyone is able to come across Star Mountain. Not everybody is able to get access to the latest KKR feeder fund. How does Opto Invest think about that in terms of getting RIAs that access and in terms of also educating the RIAs when they do access that asset class? Talk about illiquidity.
Thanks, Vadim. And audience, thanks for sticking with us here in the rain. Appreciate you guys. Maybe just, can I do a quick audience poll and see if people are still awake. How many people, for the advisors out there, how many people use alt strategies in their practice now? You raise your hand. Okay, that's pretty good. Maybe 60%? Okay, for the people that don't use them, I'm going to give you two options. Hope maybe there's a third, but maybe two. If you don't use alts and you don't use them because they're too operationally complex, raise your hand. Wow. Nobody.
Okay.
If you don't use alts,
Job well.
Easy.
I guess that problem's solved. If you don't use alts because you think it's not worth the illiquidity or the strategies don't add value, raise your hand. Don't be scared. We won't come attack you afterwards. Okay.
There are tasers out there.
There's got to be another reason, but I'm not going to keep. So that's good
Yes,
context.
Now we're stumped.
Yeah, now we're stumped. Come and tell us afterwards why you don't use alts if you don't use alts. So going back to education, I mean, I think I've been in the alts business, in the high net worth or mass affluence alts business for almost 20 years now, and I think a couple things that I saw that were missing, and the reason why I started Opto with some of my colleagues here in the audience is one, a lot of the education and advice that's in the market has been driven by managers, which is great. They have a lot of good data. But it also, some people are concerned that there may be some conflicts in there. So there's a need for non-conflicted advice at the financial advisor RIA level. That's one reason. And another reason is I ran into a lot of advisors that said, I know I want to use alts. I'm interested in it. I know institutions do it and they get better outcomes and blah, blah, blah. I've heard you guys say it a million times. But I don't understand how to construct a holistic portfolio incorporating alts and what that means. I don't know that I need all the alts. Maybe I just need some. Maybe I have some real estate. I need some venture. And so, what we did building Opto is we created a technology platform where RIAs can get on our software. We can ingest their holdings, and we can model out what it looks like, various different combinations of exposure to alternatives, whether it's private equity, venture capital, real estate, private credit. We can help them model out what that looks like. We can help them research and diligence managers. So we love our managers, and we do a lot of independent research and diligence on managers and help them explore different strategies. And then we can build a platform-level strategy around that where they can execute and say, look, I'm really excited about building a private markets portfolio for my clients. I think they want real estate and venture. Let's put something together with the best of the best, and we can run that through our software. So, we have a lot of great solutions that are out there from different individual managers. I think, Access has been a story that's been told for the last 10 or 15 years. I think we're getting to the point where access is much more broad, and what people need now is advice and customization. I think that the GPs, and look, I worked at an asset manager, so I say this with love, but the GPs have been in the driver's seat in the alts game for a long time, and I think now the tools and the access are coming out where the RIAs can get into the driver's seat and take more control of their alts exposure.
It's a good point. I think the alternatives education component is super important. And so, Matt, it's one thing for an RIA, for an investment committee to understand something like private infrastructure. It's a next order for the advisors to understand what they're investing in, and then third, to tell your end clients who have never invested in that asset class what they're allocating to. And so I think the alternatives education component is huge, and we've seen managers continue to push on that effort, and excited to partner with folks like Opto.
Yeah, and I think that's one of the things that I want to kind of unpack a bit more. Every week doesn't pass that I speak to a client on the asset management side that said, hey, I'm tired of getting small checks. I want somebody that can help me administer the process better so I can deal with just one LP facing. And there are a lot of different companies that have come into the market that have tried to fulfill that void, right? How do you differentiate yourself at Opto in terms of what you guys do and what you bring to an RIA that maybe somebody else doesn't?
Yeah, I think, look, and again, I was a little surprised. It takes the point away a little bit because nobody said they have operational issues. So I want to hear about how everyone's running ops on alts perfectly. But I think, what we've seen at least is on both sides, look, managers, of course, would prefer one point of contact, one sort of system where they can access all their LPs or all their investors. And I think RIAs want the same thing. They want one place where they can look at all their alts exposure, they can aggregate it, they can look at it at a portfolio level. So I don't think there's, to me, there's not magic in the ops part of the business. To me, having a smooth operating ops platform is table stakes that people need to build on, right? So if you are running an alts business and you don't have a way to process subscription documents electronically, you're not plugged into all the reporting platforms. If you're running a drawdown business and the capital calls are a mess, if the tax reporting is late, like even if you have the greatest strategy in the world, no one wants to do business with you. So I think when we were building our platform, we looked at that as we want to have the best, smoothest operational experience so that people can focus on building the best investment experience on top of that and not get bogged down in all the operational nonsense that comes along with a lot of alts.
I think, Lindsay, that's what you and I were just talking before we went on this panel, is your internal folks realizing what kind of a procedural operational challenge it could be, processing a lot of small checks, and partnering with someone who can offer you that really streamlines that process for you internally. But it's also beneficial for the RIA because their interface with you becomes so much more seamless, potentially, right? And, I was going to do another poll, but then based on Matt's lack of participation, I'm kind of scared now.
They participated. We just didn't get the answer I expected.
So I'm curious to hear about how people are accessing alts in terms of wrappers. Maybe if you can shout it out, or I'll shout out a couple of things: interval funds, tender offer funds, business development companies, feeder funds. I'm assuming those things are familiar to some of you, all of you. And, Brett, business development company, something that's been around since the 1980s. I think it's a great vehicle. Since the great financial crisis, the vehicle has really taken on a different life, in my opinion. Historically been a venture capital for retail investors, if you will. After great financial crisis, I had the pleasure of working on one of the first BDCs for Goldman Sachs. Now it's really kind of a lot of the private credit managers have come to embrace the product. What are your thoughts on the BDCs and how they can be suited for a particular portfolio?
So a BDC has a few advantages. One, I always like to think about the end outcome that you're trying to generate for your clients and purpose-built investments. And ultimately, I guess maybe another show of hands, does anybody think there's any risk in the economy over the next 12 months that we could have a recession? There we go. Okay, the hands are okay. So so at least we're all agreeing here that there's some tail risk out there. Anybody think that the stock market's going to continue to grow 15% year over year? No? Okay. So, there is? All right, we got our bull. March hard. Well, God bless. I guess we all hope so, right? But probability at some point will be a headwind. So when you think about what is likely to occur with the economy, and you think about what are you putting your clients into that can be defensive, can be less correlated, can continue to have stable income, if we do have a recession, do people think that rates will drop again? Yes, reasonably likely to occur, right? Almost impossible that they don't. And then you're going to be back to an environment where it's really hard to generate income. And so the concept of alternatives is interesting. The percentage of the companies in the United States and globally that are private versus public, it's far north of 90% of the companies are private. So to say that you ignored 90% of the investments in the world would probably be a little bit strange. And the concept that Lindsay mentioned is that, okay, you don't have a daily stock trading price, but I guess so what? What is that achieving for you when you think about capital protection, yield, and so forth? So what a BDC does is it creates a structure that can enable additional liquidity. It has additional governance. It actually has additional tax benefits for U.S. taxable investors, and it has additional benefits for international investors as well as reducing some friction costs relative to other vehicles. So that was some of the studies that we went through before Star Mountain launched its first BDC, and of course KKR has a very large BDC and so forth. So I think there are a lot of structures, but I would just encourage people to think about what's likely to come and what are some vehicles, and most importantly, it's the strategies that we all employ, and how can you get access to those strategies for when inevitably rates reasonably are likely to drop at some juncture, and inevitably the economy goes through some level of challenges. How can you get in front of that from protection, yield, and correlation for your clients?
Yeah, I think one of the big things that we think about when we're looking at strategies and structures is matching those two things, right? So there's a lot of people trying to provide liquidity to alts with illiquid underlying, and that can create some mismatches and it can create problems. So I think that's an important thing when we're talking about these structures and a BDC or any of these structures. So BDC could be a traded BDC where you're getting liquidity on public markets, but they have public market volatility. It could be a private BDC that offers no liquidity and thinks it's going to have a listing in the future. It could be a private BDC that offers interval fund-like liquidity. And so, all of those things are BDCs. They all are probably private credit strategies. But they have different risk profiles, probably different leverage profiles as well. And so, when you're looking at any of these quasi-liquid alts, you always have to think about what's underneath the hood and how is the manager managing liquidity and what the risk is.
Yeah, and it goes back to education, in my opinion. When a manager comes to me and says, hey, I want to launch an interval fund or a BDC, I say, why do you want to launch that? And they'll say, well, because so-and-so did it and they raised a bunch of money. I said, yes, that's great, but does that match to your strategy? And then we'll start to look under the hood and sort of really get into it in terms of what the strategy is doing. And maybe an interval fund is the appropriate wrapper, or maybe it is a tender offer fund, or maybe it's a BDC, maybe it's a feeder fund. Lindsay, when you think about bringing access to the RIAs, educating them about the different wrappers and why you chose a particular wrapper and why it's appropriate for your strategy, how do you communicate to the RIA community?
Yeah, so we're using a feeder fund to access our RIA investors. That's a change for us. Over 19 years, we have had, accepted direct commitments from high net worth individuals, and we're able to manage that internally. So we have built a very good operations systems, processes in order to service those clients. But we want to scale that. We want to leverage the good work we've done internally, and then go with a feeder that will provide the technology, the plumbing that makes it easy on the other side for the RIAs. We want it to be easy for you to fill out a sub book and get all the information to us. We want you to have a point of contact as an investor with us. But we also want it to be something that goes directly into our funds. So you're pari passu with all of our other investors. And so for us, the feeder structure was most appropriate because it was a simple way for us to match up the structure that we already have, but provide some operational efficiencies, provide some technology and interface that becomes useful. The other thing we liked about it is just having a third party that was doing some vetting of our strategy, of our team, and preparing material that, we have our own material, but for that, the feeder manager to come into our office, spend a lot of time doing due diligence, create a due diligence report that can be shared with RIAs that we don't get to see, but becomes something that's useful from that education perspective, as you said, Vadim. That is third-party educational material that we can leverage so that the end clients can get to know us easily. And then we also, what was important to us was a structure that was well known, had been utilized before, sort of had been tested, and something that RAs are familiar with, where they've got logins, they're used to the interface, and so that it would be fairly seamless. But what we want to see is not just sort of the brand names coming to you all through those feeders, but to have a much more diverse offering. And so we've focused on the education with the feeder managers as to what value add we bring, and then they translate that into material that they share with the RIAs. And then, of course, we use technology, webcasts, other things to then directly communicate our strategy and educate on why it makes sense to invest in middle market, value-oriented private equity, et cetera. So it's putting it all together and having a partner who can help us package that in a way that works for us, but also in a way that works for the RAs.
Yeah, thanks for that. I will say that I think innovation in product wrappers has been really fast over the last 5 to 7 years. One of the things that I love about being an asset management lawyer is I get to innovate on different product structures. Matt, KKR has an interesting, innovative product in the market. I don't know how much you can talk about it. I don't see any compliance folks in the audience, so hopefully you won't get any trouble back home. But the conglomerate products are very interesting.
Yeah, so we're past the SEC commentary period, so we can certainly comment. We're live and launched, so it's okay. But I think when we think about wealth management clients accessing alternatives, there's always trade-offs depending on what structure a wealth management client is going to come in. To Matt's point, there's a multitude of different BDCs. The 1940 Act vehicles provide very easy operational access for wealth management clients. But the trade-off is you might not have direct access to a manager in those vehicles. So it might be appropriate for certain asset classes, and we've structured 1940 Act vehicles in credit and real estate where you can purchase it with a daily ticker, you get quarterly liquidity at 5%, low minimums of $10,000. But SEC has granted exemptive relief for credit strategies. They haven't done so in private equity for a manager like KKR to offer wealth management clients the same access to our institutional funds. So the SEC has said in a 40 Act vehicle, a manager like KKR cannot share in deals from their private episodic drawdown funds with a registered vehicle. That creates a lack of access for wealth management clients. And so what we've done in infrastructure and private equity is we've taken all those same features of a 1940 Act interval fund, but we launched operating companies. They're not funds. SEC will get mad if I call them funds. They're vehicles or structures, but essentially what you're doing, you're purchasing shares in an unlisted Berkshire Hathaway, where we have to have 60% of control-oriented investments in this structure. But what it allows us to do is provide exact same access for wealth management clients as our institutional clients, pari passu. So similar to the feeder structure that Lindsay mentioned, clients coming into our infrastructure product, K-Infra, or our private equity strategy, K-PEC, are literally accessing the same underwriting, sourcing, and management teams as our institutional clients, first in the waterfall, pari passu. That's something you can't do in a 1940 Act fund within the same manager. So when we thought about how do we structure each vehicle, I think it comes down to, one, we wanted to get down to accredited investor level. So we didn't want folks to have to be qualified purchasers in order to access our strategies. And we also wanted to make sure that they were accessing the exact same deal flow as our institutional clients. And so depending on the asset class, we structure each vehicle differently, but in our K series across the suite of private equity, infrastructure, credit, and real estate, we've tried to match that asset and liability to provide access.
What's the taxation on that, Matt?
So it's very tax efficient. We've structured it so that there will be no difference for your 1940 Act funds. The only difference is you have a simple K1 versus a 1099. No state filing, no delays, which are the two biggest issues with the K1. In infrastructure, actually pretty tax efficient, so about half the distributions are return of capital, but there would be no difference from the 40 Act side.
I'm curious in terms of how you guys came about with that vehicle. Is that a conversation that you're going out to the RA community and investors and saying, hey, it'd be really great if we can access X through this kind of wrapper? Are you really going sort of internally doing the alchemy inside and then saying, hey, this is what you should be buying?
It's a good question. It took a lot of breaking glass internally for a couple of reasons. One, at the start, we wanted to get to accredited investor eligibility and to be able to have wealth management clients access our deals in-house and not have to outsource that. So that was the starting point. And when we looked at the structures available, that wasn't going to fit for private equity and infrastructure. It would take a manager a long time to replicate what we've done, given a lot of it is internal collaboration with our institutional counterparts. We had to go to every LPAC and make sure that they were comfortable with wealth management clients taking this share of investment that typically had gone out to them as co-invest. And so now CalPERS, STIRS, apologies if you're here, right? You'll get less co-invest as you partner with us, but we think it's appropriate for the individual investors to be able to access that same deal. So in our documents, without to give away some of our secret sauce, we have provisions that enable these vehicles to access directly alongside our institutional funds in every deal that we do. So I would say it's a combination of what do we want to provide to the market, what do RIAs need to be able to access the KKR platform or alternatives, and then how can we configure that structure to make it work internally?
To me, something that you said is focusing on the individual investor at a shop like KKR, historically an institutional shop, just shows the importance that the RIA community and the individual investor will continue to play in this space. And going forward, I think, one of the things that I'm curious about is the innovation and the technology that's continuing to being adopted by the asset managers and by platforms like Opto. Matt, what do you think in terms of future trends and where is this space going? Is it more education? Is it more product? Is it easier access? Is it just go through Opto and you'll be fine?
Yeah, we can end the panel now. No, I mean, I think there's a little bit of asset class differences, right? I think, private credit, we have a lot of good structures. There's a lot of opportunities out there. People are learning more about different sectors within private credit. We've had a lot of mega unitranche deals out there. Now we're seeing more lower middle market. We're seeing more mezzanine and other strategies. I think, basic real estate strategies have been out there for a long time. We're seeing more PE, but PE, I think, is still hard to access in a lot of ways. And so is venture. I mean, we haven't talked about venture at all up here, but venture remains, one of the most difficult asset classes to access. So, I think it's the future trends are we're going to see, a more leveling of the playing ground across the asset classes. And, I think I go back to one of the comments I made before. We're going to see, because of the proliferation of products, we're going to see individual practices be able to get much more customized, create much more bespoke portfolios for their own clients, rather than and it be a differentiator for their practice, rather than just taking the large off-the-shelf solution. So I think that's the direction we're going, and I think it also provides opportunity for smaller and middle and mid-sized managers that may not have massive built-in distribution teams to get in front of these practices and bring some value and generate some alpha.
Yeah, I mean, I think venture is a good one that we haven't touched on, but I keep thinking about whether, as I mentioned earlier, I think a BDC is a great way to enter a venture space, and also venture secondaries. I'm sure there's a lot going on there. Brett, we have about 2.5 minutes left. Future trends, how do you think about Star Mountain, RIAs, where the private markets asset class is going?
We work with about 40 RIAs currently, both domestically and internationally. And as I guess see the BlackRock tent there, it is a good branding where it reminds me a recent report they just came out with where nobody has a crystal ball, but as they look at some of the highest returning strategies they think that will achieve over the next decade, they said private credit. And when you think about a product that you might be able to get a higher return potentially than public equities or other asset classes that are far more risky, at least measured in capital structure, far more volatile, don't give you the inherent liquidity. When you think of the word liquidity, one good way of liquidity is getting cash every month or every quarter, right? So a lot of strategies can give you constant systematic liquidity. And so I think that another word that's related to education is data. As you all and your clients become more informed as to the return opportunities, why would you not hunt for better returns and higher returns? And as we think about basic laws of supply-demand, whether it's buying a house downtown local here or something that's 50 miles away that's the same house, the price is very different. Right? If you think about that basic logic of supply-demand, whether it's a stock, a bond, artwork, a bottle of wine, a car, right? If a lot of people want the same thing, it doesn't mean that it's less risky just because people pay more for it. And I think there's a bit of a misconception. So I think that as BlackRock, KKR, others continue to provide more data, more information, you naturally will have your clients, of course, want better returns, less volatile returns, more tax-efficient returns. Hence why so many of us have been, in our case, it was reactively building products for all of our high net worth and RIA clients that wanted different structures with leverage, without leverage, different liquidity. And so I would guesstimate you will continue to see capital inflows into better returning investments.
Thanks for that. And by the fact that people are still listening to us in the rain, I think it's a good indication that Maybe we'll come back next year and talk about Alts 2.0. Thanks, everyone, and thanks for joining.
Thank you.
Thank you, everyone.